All right, welcome back to the REIT Report, where we break down real estate investment trusts in a simple, practical way for income investors. Now, today we're looking at WP Carey, ticker symbol WPC. WP Carey is one of the bigger names in the net lease REIT space. And, this is a company that owns properties and leases them out to tenants under long-term agreements. In many cases, these are triple net leases, meaning the tenant is responsible for things like taxes, insurance, and maintenance, and that can make the business model relatively simple, stable, and cash flow focused. But WB Carey is also a REIT with a complicated recent history. For years, investors viewed WP Carey as a reliable dividend compounder. Then the company made a major strategic shift by exiting office properties, and that led to a dividend reset. So today, the big question is this: is WP Carey now a cleaner, stronger income REIT, or is it a turnaround story? Let's start with the business. WP Carey owns a large portfolio of single-tenant net lease properties. These properties are spread across different industries, tenants, and geographies, with exposure to both the United States and Europe. The company focuses... Sorry about that. But yeah, the company's overall focus is heavily on industrial, warehouse and retail properties, which is a positive in my opinion because these categories generally look stronger than traditional office real estate. That matters because office has been one of the weakest areas of commercial real estate. Remote work, lower office demand, and refinancing pressure have made office properties much riskier than they used to be. WP Carey decided to move away from that problem. And while the dividend cut hurt shareholders, the long-term goal was to simplify the company and make the portfolio more durable. Now, when I look at WPC today, the first thing that stands out is diversification. This is not a tiny REIT. Depending on one tenant or one property type, WP Carey has over 1,700 net lease properties, hundreds of tenants, and a very high occupancy rate. That gives the company scale. It also means that if one tenant has issues, the whole business does not fall apart overnight. Another important strength is rent escalations. One thing I like about WP Carey is that most of the leases include built-in rent increases. Like it's actually built into it. Like the tenants expect their rent to go up. So it's not like it's a total surprise when it does go up. That helps protect the company from inflation over time. In a world where expenses go up, interest rates move around, and the dollar loses purchasing power, having contractual rent growth is valuable. Let's talk about the dividend, though. WP Carey currently offers a yield in the neighborhood of 5%. For income investors, that is attractive. It is not the highest yield in the REIT market, but it is meaningful, especially if the payout is supported by AFFO. And that's basically after funds from operations, if I remember correctly. I always confuse FFO. I'm not going to lie. I confuse FFO and AFFO a lot. But yeah, if I remember correctly, hold on. I got to recall this. I'm having a blank. Oh yeah, adjusted. I don't know why I said after. So it's adjusted funds from operation. I know FFO is funds from operation. I always forget about the adjusted part for AFFO. Sorry, it eludes me from time to time. And also, it's morning time, and I can't think properly. I'm sorry, you guys. But anyway, adjusted funds from operation. And that is the key with REITs. You do not want to look only at the dividend yield. A high yield means nothing if the payout is not sustainable. You want to look at AFFO, which stands for adjusted funds from operations. I got to say it again. AFFO is one of the most important cash flow metrics for REITs because it gives a better picture of the money available to pay the dividends, essentially. In WP Carey's recent results, AFFO per share showed growth, and management raised its full year 2026 guidance. That's a good sign. It suggests the business is not just surviving after the office exit, it is starting to rebuild momentum. The company has also been attractive on the acquisition side. WP Carey specializes in sale leasebacks, build to suits, and net lease acquisitions. That means it can work directly with companies that want to free up capital by selling their real estate and leasing it back. This could be a good niche because WPC gets long-term rental income, while the tenant gets capital to reinvest in the business. But now we have to talk about the risks. The first risk is interest rates. REITs are sensitive to interest rates because they use debt, they pay dividends, and they compete with bonds and money market funds for investor attention. If rates stay higher for longer, WP Carey's cost of capital could remain elevated. That can make growth more expensive and put pressure on valuation. The second risk is the dividend history. Even though the office exit may have been the right strategic move, the dividend reset damaged trust. Some investors bought WPC because they believed the dividend was extremely dependable. When that changed, the market had to re-rate the stock. So even if the new dividend is more sustainable, WPC may need time to rebuild credibility with income investors. Here's the thing. If you were all in on WPC, that's your problem. Never be all in on one REIT. Any REIT, by the way, can cut their dividend in half, can cut their dividend entirely for even a few quarters. It can happen. This is why I say just stay diversified. Don't be concentrated in a few specific REITs. I think, and it's not financial advice, this is for educational and entertainment purposes only. Always talk to a financial advisor, but my philosophy is this. I stay diversified in the REIT sector because, one, I don't want to be reliant on one single REIT for retirement. I think that's just not a good idea. Second, it's just like, I don't know, it just feels wrong to rely on one specific REIT. I do want to say this, though. WPC is not a super fast growth REIT. This is not the kind of stock you buy expecting explosive upside. It is more of an income and steady cash flow investment. So the question is whether the yield, AFFO multiple, portfolio quality, and growth outlook are attractive enough compared to other net lease REITs. Compared to names like Realty Income, Agree Realty, or Triple N REIT, WP Carey gives investors a slightly different flavor. It has more international exposure, a more diversified property mix, and a recent turnaround angle. That can make it appealing, but also a little more complex. For me, the bull case is pretty clear. WP Carey has a large diversified portfolio, high occupancy, built-in rent escalations, a solid dividend yield, and improving AFFO guidance. The company has already taken the painful step of cleaning up its office exposure. If management keeps executing, WPC could become stronger and a more respected income REIT again, but the bear case is also clear. The dividend cut is still fresh in investors' minds. Interest rates remain a headwind. The stock may not deliver huge growth, and investors have plenty of other net lease REITs to choose from. So WPC has to prove that the new strategy is working. My overall view is that WP Carey is a solid income REIT with a recovery story attached to it. It is not perfect. It is not risk-free, but after the office exit, the business looks cleaner, and the dividend appears more grounded in the company's current cash flow. For long-term income investors, WPC is definitely worth researching, especially if you like net lease REITs and want diversification beyond the usual names. Personally, I would not treat WP Carey as a guaranteed winner, but I would treat it as a serious REIT watch list candidate. The main things I would watch going forward are AFFO growth, dividend increases, acquisition quality, tenant health, debt costs, and whether management continues to rebuild trust after the dividend reset. So the bottom line is this. WP Carey is a cleaner company than it was before. The yield is attractive, the portfolio is diversified, and the turnaround is moving in the right direction. But investors should still respect the risks. I don't know. I think that here's the thing. I love having WP Carey in a portfolio. I do. I think it's great. And as long as you're diversified, that's the key. You don't want to put all your eggs in one REIT instead of all eggs in one, but you know what I mean. Anyway, you don't want to put all your eggs in one REIT, man. I think it's good to be diversified. Even though this is not financial advice, I think that spreading out your risk is the smartest thing you could do. And there are plenty of great REITs out there. You don't have to rely on just WP Carey or Realty Income, even though I love both of them. But I will tell you this. I would rate WP Carey a 7.5 out of 10. And here, I guess I could give you a few reasons. My rating for WP Carey the reason for it is I like the diversified portfolio, the attractive dividend yield, and the cleaner business model, after the office exit. But because of the recent dividend reset, interest rate pressure, and slower growth profile, I can't quite put it in the elite REIT category yet. I just can't. I can't do that to myself. I can't. And anyway, that's pretty much it for WP Carey, ticker symbol WPC. On the REIT report, this is not financial advice. I want to make that very clear. Always do your own research, compare WPC to other REITs, and make sure any investment fits your own goals, risk tolerance, and income strategy. If you enjoyed this episode, hit like, subscribe, and let me know in the comments, are you buying WP Carey? Are you holding it or are you staying away from it? Me personally, I think it's fine to add to your portfolio as long as you're already diversified. Never go all in on one REIT. That's the one. Never go in on one sector even. I don't know. That's just me. I'm a highly diversified man.